Hi, everybody. Welcome, guys, to another webinar of our series. Today, we're going to talk about Fibonacci extensions. We're going to continue down our path. Last webinar, we've went over Fibonacci retracements. Today, we're going to go down once again the path of technical analysis, and we're going to add to the mix the similar but not so identical technical indicator, which is Fibonacci extensions. It has pretty much all the similarities that the Fibonacci retracement tool has. However, the Fibonacci retracement, given its name, it's best suited when you have, let's just say, a move on the opposite side of the direction of that prevailing instrument's uh, nature, if you like. And therefore, with the Fibonacci retracement tool, you are looking forward to, or you are extrapolating how far the retracement is going to be. And the reason why you use the Fibonacci retracement as a tool is to highlight potential areas or levels that we may see the price action bouncing from. On the flip side of the equation, when we talk about Fibonacci extensions, we are looking at possibly the end of the retracement, the end of the pullback, if you will like, and from there onwards, if the instrument is headed towards its primary direction, how far could we expect the price action to go given this Fibonacci extension as a tool? We highlight once again potential areas given the Fibonacci sequence, the Fibonacci ratios of where the price action could once again face resistance. Again, you can compare and contrast Fibonacci retracement. It's all about highlighting on the chart potential areas of support. Fibonacci extension is probably best suited to find potential areas of resistance into the future once that correction has been completed. Okay, if this is not making any sort of sense, please bear with me. We're going to go through this in detail to get the grasp on things. Okay, so this is a quick risk warning and a disclaimer. I'm not going to go over the whole thing and read it out. The gist of the thing is that this information contains no information. This webinar contains educational material only. There is no any sort of investment advice or investment recommendation contained within these kind of slides. We just use this for educational purposes to highlight the usefulness of these kind of tools and how you can benefit from using them. So don't expect to get some sort of advice from this kind of webinar. Okay, so the redistribution of this material is strictly prohibited. And without further ado, let's get started. So again, I'm highlighting that we are continuing down our path on the technical analysis front. We have split the technical analysis as a school of thought into two categories. One is charting analysis, and the other one is mechanical analysis. So at the end of the day, let's just go over what technical analysis is. Is essentially looking at past price action and volume and the open interest of a specific instrument or any given instrument you would like. And by using technical analysis methods and tools that we have available at our disposal, we, in a sense, trying to predict where the price action is going to head it towards to next, extrapolating from where it has been already. Okay, and if the price action has not been through that level or that price point before in the past, we use other specific tools that could help us kind of have a much more informative kind of approach when we go out trading. Such tool, given the occasion, is the Fibonacci extension tool. So most traders have encountered that do actually use Fibonacci extension tools are using the tool specifically when the retracement of a specific instrument has ended and the price action is once again headed towards a territory has not been seen before. So therefore, you use the Fibonacci extension tool in order to, let's just say, map out the road of where we can find some sort of possible resistance levels into the future, primarily extrapolating that markets do move in some sort of predictable waves, or that we, by using the Fibonacci extension tool, we abide by the laws, quote unquote, laws of the Fibonacci as a concept. So therefore, we just guessing at the end of the day where the price action is going to head towards to next. Why not use the Fibonacci extension in order to highlight some potential areas that may prove to be a resistance level, mainly because we don't have any other data points or reference points in order for us to make a much more informed decision. Again, if this does not make sense, please bear with me. So again, technical analysis uses past price action, volume, and open interest. Okay, we look at that, those kind of aspects of things, of instruments, of assets, in order to make much more informed decisions. And this school of thought, technical analysis, has, from my point of view at least, two main branches when it comes to technical analysts and technical indicators in general. So you have charting analysis, which in a sense you go on top of price action and you draw levels where the price action has found support or resistance. So levels and areas that the price action has interrupted its primary kind of trend, if you will, like where price action has stalled or where the price action has rebounded from. Those are what we call support and resistance levels. By doing charting analysis, you in a sense go on top of chart on top of the price action and just draw simple lines to highlight these key areas. We, under charting analysis, you also have drawing trend lines to identify the current trend, where it's headed at, whether it's upwards, downwards, or the sideways kind of fashion. You draw that onto your chart in order to have a visual illustration and not forget where the price action is headed at. Primarily, you can spot where the price action is headed at by looking for higher highs and higher lows, or lower highs and lower lows, depending on where the direction is. But we use charting analysis again to let's just say keep that visual illustration right in front of our eyes and not miss the point. Okay, so other things you can plot on your chart when it comes to charting analysis are channels. Also under charting analysis, you are dealing with chart patterns, super important. And also you can look at individual candlesticks and see what kind of interpretation they give you. For example, if you see a morning star kind of pattern or an evening star kind of pattern, or three black crows or three white soldiers, or a cup and handle formation, or a triple top or a double top, or a head and shoulders formation. All those are super beneficial for those that actually conduct technical analysis on charts. And there is the proverbial kind of analogy that, or the we call common wisdom, if you will, like in the markets, that whenever a bunch of people are looking at the same thing and they have the exact same kind of classification, most likely they tend to make that outcome come into fruition by their actions, what we call a self-fulfilling prophecy. That plays a lot role into this. Psychology plays a lot more into the technical analysis sphere as well. But yeah, let's not move in that kind of direction. Let's keep back to the point. So we have charting analysis. The other category is mechanical analysis, which is primarily technical indicators that you, or computerized kind of algorithms, in a sense that you adjust the parameters accordingly, and they spit out a visual illustration or some information that it's helpful to you. And some indicators that fall under mechanical analysis, pretty much every indicator falls under mechanical analysis. We have on chart, therefore, and off chart indicators, another split of this kind of category of the whole thing. So you have on chart indicators being moving averages, Bollinger Bands, Ichimoku Cloud, Parabolic Star, Fibonacci extensions, and retracements fall under the on chart category, because you are using technical indicators that give you information on top of the price action, whereas off-chart indicators such as RSI, MACD, ADX, momentum, and all that kind of stuff go on a separate window below the chart. Nonetheless, they are indicators as well, but they don't go on top of price action. I found that to be a very nice distinction between indicators in order for you to remember them. So off-chart indicators, most of them, or pretty much all of them, are oscillators. So they capture this kind of wave patterns of movements, you can plot them on your chart and see for yourself. So RSI is what we covered in the past. Moving average, convergence, and divergence was another one. ADX we're going to do in the future. Momentum is another one. So there's a lot of technical indicators. These are not limited to just a few examples. Most of them we have covered so far. We're going to cover a few more, and then we're going to kickstart the show once again. So therefore, today's topic is going to be on Fibonacci expansion, which falls under the mechanical analysis category of on-chart indicators. Again, it's another technical analysis tool. So what are Fibonacci extensions? Let's go ahead beforehand and just lay out what Fibonacci is. If you look at this word and you see you don't have any sort of recollection or memory or knowledge of what it is, fear not, this is an example. So Fibonacci, the Fibonacci as a sequence was identified by an Italian mathematician named Leonardo Bonacci at the around and about the 13th century. And however, this kind of concept of or topic of this sequence was widely believed that was introduced to Bonacci by excuse me, some Indian merchants that they trace back their roots of this kind of sequence of this revelatory kind of process of inventing or just tumbling down and just finding it in front of them. We're talking about a 6th century BC in ancient India. It goes as far as that back. And the Fibonacci sequence is, at the end of the day, also closely connected to what we call the golden ratio, which is a specific ratio. But for some reason, our brains tend to recognize kind of instantly without, let's just say, measuring things. It's just something innate in us that seems to like this kind of proportional kind of ratio, which is the 1.618, which is also known as the divine proportion. And this kind of ratio can be found, interestingly, in pretty much everywhere around us, in facial, in faces, in anatomical kind of body parts of human beings, of animals, let's just say in seashells, in galaxy formations, in sunflowers, in trees, in pretty much everywhere. Okay, historical artifacts, architecture, you can find it, you can spot this ratio pretty much everywhere around us. And if for some reason this is exactly like that, the golden ratio 1.618, we get some sort of alluring kind of police within us. For some reason it clicks something within us. It's something that we for some reason we are drawn towards to. Okay, so the Fibonacci sequence, at the end of the day, we mentioned that it was introduced by some Indian merchants to Bonacci in the 13th century with Italian mathematician and all that. What is the sequence at the end of the day? So you have two prime numbers, at least the two basic components, the 0 and 1 being the two initial kind of numbers that we have on this series. And in a sense, you get the add-on numbers by adding the subsequent number with the prior one. Okay, so it's the sum of the prior two numbers. So for example, you start with 0, 1, and you add those together, you get 1, 1, and 1, then you close the number. Let's just say 1 and 1, 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5, 3 plus 5 is 8, 8 plus 3 is 13, 13 plus 8 is 21, 34 is equal to the 13 plus the 21. And if you add those numbers together, it goes indefinitely. Okay, this is the Fibonacci sequence. This is what the famous mathematician kind of Bonacci not revolutionized, but broadcasted to the world and made it kind of known. Okay, so when it comes to trading, how do we use that? Okay, pretty much the sequence is irrelevant to us. What we do is we use ratios is much more appropriate when it comes to trading, because as you know, the market has ebbs and flows. So it moves to a specific direction one level at one point in time, and then it comes back down, and once again up, and once again down. And then you have shifts in trends and all that kind of stuff. So traders or computer kind of geniuses figured out a way to algorithmically compute this and use this as a technical indicator, and you plot into the price action in order for you to get a much more better grasp of where the price action is headed at and by how much it's going to move downwards or upwards using these kind of Fibonacci ratios. Does not mean that these are accurate. These are the golden standard when you use on trading. No, it's just merely another tool of gauging uncertainty or the chaotic way of the markets. How can we at least try to capture the chaos that the markets are going through each and every day. Okay, we use this as a mere reference point when it comes to our trading journey in order to have much more informed decisions, and you will see in practice what we mean by this. Okay, so practitioners commonly use these ratio and related ratios to establish where the price action may head towards to when the price extends. This is the, in regards to the Fibonacci extension, obviously it's the same thing where the price action may head towards to when the trend retraces, you're going to have the Fibonacci retracement as a tool being much more appropriate. So which are and what are the key ratios? As if you remember, last webinar we've done Fibonacci retracement and we highlighted the most important retracement levels or retracement ratios, which are the 23.6, the 38.2, the 61.8, and possibly the 78.6 once again, or 0.2, excuse me. Being other key areas, also the 50 when it comes to the retracements. Now, when it comes to the extensions, we have all these four we have highlighted here, plus many others. So the 1.27.2, so the 127.2% level is a key area. The 141.4, another level that is key. 161.8, the most important one. 261.8, also important, etc. But we also use the 100%, much like we use in the retracement level, the 50% for mainly because it makes sense. Okay, so we like whole numbers, so 50 is half of the whole and 1 is the 100%. We use that ratio as well in order to make in order to highlight these areas and expect that for some reason it's going to be some sort of is going to be, that level is going to be of some sort of importance down the line. So Fibonacci extensions, let's explain them. Why do traders use them? So you indirectly got a glimpse by me talking about this earlier on. So Fibonacci expansions are used to identify and establish potential profit targets or levels or estimate how far the price action may travel after a pullback is finished. Okay, so let me draw a map to see a visual illustration what we mean by this. Let's just say the market moves in this kind of fashion. So it's definitely an uptrend, mainly because you get higher highs and higher lows. Okay, and for some reason you get the market doing this. Okay, plunging down lower. Okay, so if you have a Fibonacci retracement tool, okay, this is the, oh, let me, hopefully I'm gonna have a much more steady hand. Okay, when drawing. So the market is moving to the upside. Let's just say this is the 100% portion of the move. This is the 0. Now you have the Fibonacci retracement tool in order to tell you how far the price action may fall towards to. Let's just say these are the levels, roughly speaking. Okay, so maybe in this kind of scenario, this is the 38.2%. This is the 50%. And this is the 61.8. So this is the Fibonacci retracement tool. We extrapolate where the market is going to head towards to next. That we have seen in this kind of example, I'm just roughly choppy trading drawing here, that has breached the 38.2 level, then it goes down to 50, let's just say, and then for some reason finds support around the 61.8% level. This is 61.8, by the way, sorry for the terrible handwriting. Okay, so price action bounces and once again moves upwards. Now we are dealing with a level one seen before, which is, this is the former peak. Fibonacci extension tool is going to help us identify where the price action is going to head towards to next. So we use this tool to highlight potential areas into the future. You'll see it on a visual illustration later. So this portion from here until here is what we call a retracement. Is meant, my God, my handwriting is terrible. It's a retracement. So the end of the pullback is, in a sense, comes at this kind of level. So the end of the retracement is here because we have finished the, let's just say, the fall, and the price action is heading once again to the primary direction, which is this upwards. Okay, so we are extrapolating that it's going to continue onwards from here. Now we're looking for where the price action is going to stall towards to next by using the Fibonacci retracement as a tool. So again, a rough visual, ugly illustration by my handwriting when it comes to why we use how we use the Fibonacci extension and why it is important. Okay, so Fibonacci extensions are used to expansions, excuse me, I used to identify and establish potential profit target levels or estimate how far the price action may travel after the pullback is finished, and they are used to map out how far the next price wave could move after the end of a pullback. Okay, again, this is the pullback. It has ended. Now, how far you're going to go into the future, how fast is the price action going to go to next? It's going to be given by momentum and all these other indicators. The Fibonacci extension is mainly laying out kind of potential areas of where the price action is going to move towards to next. Okay, so Fibonacci expansions use 3 points: the start of the move, the peak of the move, and the retracement of a pullback. So this is starting point is here, end point is here, and this is the retracement bottoming. Okay, so you're going to draw a line like this. In the tool, you're going to connect these levels, and from there onwards, the Fibonacci extension tool is going to extend. It's going to give you manually or by itself, use it because it's a computer algorithm or technical indicators. All of them are where the price action levels of importance is going to be using this Fibonacci kind of rationale. Okay, so Fibonacci extensions can be used for any time frame or in any market, much like pretty much every other technical indicator. Typically, clusters of Fibonacci levels indicate a price area that will be significant for the instrument and also for traders in their decision making. Now, since extension levels can be drawn on different price waves over time, when you see multiple levels overlapping or converging at one point in time or at one price at a time, that could be a very important area. Okay, so imagine you have drawn a Fibonacci extension level on the A to B kind of scale on the elite wave. Let's just say from here onwards. What I mean by this is a microcosm. You can apply this kind of extension tool on specific portions of the price action. Not its entire history, but you can do an entire history as well and highlight the potential areas to see their importance. And once you see overlapping of this kind of Fibonacci extension levels, you have much more higher confidence that possibly that is a level that we may encounter into the future, or where the price action is going to stall towards to and find a resistance level there. Okay. So what is the difference between Fibonacci extensions and Fibonacci retracements? I think we have covered that already. So while extensions show the price, we potentially show where the price will go following a retracement, the end of the retracement, Fibonacci retracement levels indicate how deep a pullback or a retracement could be. Okay, so Fibonacci retracement as a tool tries to measure this. Okay, how far it's going to fall after interrupting its primary direction. Okay, whereas Fibonacci extensions take into account this retracement and say from here onwards how far the price action is going to bounce and move towards the next. Okay, extending in a sense the entire kind of move. Okay, so Fibonacci retracements, in other words, Fibonacci retracements measure the pullbacks within a trend. Okay, while Fibonacci extensions measure the impulse waves of the direction of the trend. Okay, so this is on a grander scheme, a piece of a larger wave. Okay, this example is just a microcosm of that. Okay. This is a visual illustration of Fibonacci extension. So what we have here, Aussie dollar, okay, chart. What is it? Daily chart and a 1 hour chart. Okay, 1 hour chart of the Aussie dollar. Okay, in this kind of level, we have seen the price action trending in a sideways fashion. Not the ideal scenario to use the Fibonacci extension, but this is for getting the grasp here. This is for visualizing how you can use this as a tool. Okay, so we have the start of the move. Let's just say this is an impulse wave. Okay, this is the end of the wave, and then now we are in a what we call a pullback kind of phase, even though it would have been much more better to have something like this. Okay, and you see the price action heading towards the desirable direction once again, which is what, upwards. Okay, for some reason the market judged, or market participants judged, that the price of Aussie should be weaker, the dollar should be stronger, and therefore the price action went to lower ground. But this is what we call a retracement. Okay, so now the market has retraced a portion. We are attempting to see whether we're going to see the price action extending towards the primary direction yet again after this brief kind of retracement, this brief pause. Okay, so the start of the move, let's just say, is there. Could have been down here. Okay, peak is up there, the end of the move is there, and this is possibly the end of the retracement. And we have a question mark here because at this point in time, we have no clue whether the retracement is nearing its end or has ended. There is no definitive signals because we continue to see lower highs and lower lows, at least in this kind of small time frame that we look at the price action. Okay, maybe the price action is going to do this. So therefore, Fibonacci extension is not going to be a nice tool to use. Okay, we are assuming that for some reason we're going to find enough support here at this level. And how do we know? You're going to see, because we're going to use the Fibonacci retracement to see whether it's going to be some sort of importance. We are just assuming with limited to no available data in front of us that for some reason the retracement is going to end there, and the direction of the market, the direction of this instrument is going to head towards to higher ground. Okay, how we know this? We don't know. It's just assume. We just make a scenario here. This is what we call a base case scenario construction. Okay, so. And the reason why this is wrongly or mistaken to do this is because to assume that the price action is going to stand to upwards is because we don't have a primary trend here, because we have a sideways price action motion at best. Okay, this is going pretty much nowhere. Okay, endless. So you see these two channels. Okay, these levels, 1 and 1, 2. The price action has been confined within these levels for quite some time. Okay, a few weeks now. Why assume that the price action is going to head to higher ground? We have no valid reason to believe so. This instrument is trending in a sideways kind of fashion. Why extrapolate that for some reason it's going to extend to the upwards where there is no upward trend? Okay. Now the reason why I'm using this example is to highlight the reason why we should not use this tool in this kind of example. Okay, so yes, you can use the Fibonacci extension and retracement or any given other Fibonacci tool available to you on your chart and make informed decisions, or at least highlight potential areas. But please know the foreground, the background is much more accurate when you use this tool or tools when you have a trending instrument, either to the upside or to the downside. Sideways is not that kind of helpful. Okay, and this is why I use this example as a visual illustration of how not to use this. Okay, so let's just say I took a different approach here. So let's for some reason assume that the price action is going to extend to high ground. We use the top start of the move, the end of the move, and the retracement, assuming that this is the end of the retracement. And the Fibonacci extension tool gives us potential areas, the 127.2, the 141.2, and the 161.8 levels. This is the most important out of the three. However, one and the other one are also important. For example, I use this potential profit target here, assuming that I've entered the position down here to the buy for whatever reason. I don't see clearly the reason why I'm going along here, because the end of the pullback is not then there yet, if this is a pullback, because we are still in a sideways price action. Okay, but let's assume that we see the bottom here and we see the end of the retracement here, and the price action does this. Okay, I go long here, and then where I'm gonna have my potential exit target, Fibonacci tool, Fibonacci extension tool could be useful, and we can have exit targets here, here, and here. Okay, while using this, if there is price action around this kind of levels, and you see the price action stalling here, let's just say this level is much more important than the other two. Okay, so you need to have confluence, you need to have overlapping. That's what we meant beforehand. Use support and resistance levels, just the plain and bland and simple ones, and then use the Fibonacci extension tool to see whether there's some overlap. If you have these levels kind of aligning kind of perfectly, please use that as your potential entry or exit point, depending on the situation. Okay, so we look for confluence, we look for conjunction. Okay, so same example, but we add on to the chart the Fibonacci retracement. So this is the start of the move, this is the end of the move. Fibonacci retracement tool gives us the levels 23.6, 38.2, the 50, and the 61. And currently we are at the 51 level, 61.8% level, the most important level when it comes to retracements. Okay, if this level fails, we're probably going to have the complete reversal of the move. So we went from here up to there, and then we back down here. If, however, this level stands, and we see in this kind of example, super simply, that the price action has bounced once from this level, twice, and 3 times. Okay, we can assume that this is going to be some sort of support. This area has acted as an important level in the past. Mainly it was resistance, it was broken above it, and now it became support. You can see clearly here. We can extrapolate that this level may be indeed a confluence between the 61.8, a valid support level, no resistance, and the price action is going to do this. Okay, so from here onwards, if we do see actually this, a lovely level for us, for example, to go long, maybe somewhere around here. So we buy here, and then we use the Fibonacci extension tool, the one we had, to project where are we going to exit. Is it going to be here, here, or here? That is ultimately dependent upon the interest that the market has around this instrument, which pretty much most of the times you cannot gauge accurately. Can use volume and open interest to see and momentum and all those other indicators to see how strong the bulls are in this kind of case, if they are strong. And also it depends ultimately on your risk tolerance. So if you are not willing to hold this position and wait for the 61.8% level to be hit by the rise of the price action using the strength of the bulls, maybe you're going to use the closest one, which is the 127.2% level for a quick and easy small percent gain, or you can hold the position if you are much more risk taker. You can use the 161.8, or you can use 200%. Okay, whatever that is, that's up to your tolerance. The reason why we use the Fibonacci extension tool is because we probably we do have in the back of mind, on the back of our minds, that the price action does move in waves. So therefore, if it goes up there, possibly it's going to come down. So why not exit the position here and keep the position open, and the price action does this once again. Okay, so it's for the ease of mind to have this kind of targets, much more easier for you to manage your positions as well. But yeah, that is primarily how we use the Fibonacci extension as a tool. We have a starting point, we have an end point, and then we have the end of the retracement. Okay, Fibonacci extension tool. So you draw a line like this, and the Fibonacci extension tool gives you all those levels. And again, at the end of the day, these levels are purely for highlighting them onto your chart. They're not supposed to come through. They are not this Fibonacci extension tool is not predicting the future. No, it's merely highlighting possible areas of support and resistance in this kind of scenario. We're using this only as a valid reference point. Okay, it's not written in stone that the Fibonacci extension tool is going to work. No, we use them merely for targets or, again, key areas if we do not have past prior action data to let's just say give us confidence that, you know what, there's going to be some sort of resistance or support there. Okay, so that's how we use the Fibonacci as extension tool. Then same example, we use what we call many other different indicators. For example, down here we have RSI. We're not using merely the Fibonacci retracement and extension as tools. We have two only technical indicators. Why use two and try to make informed decisions when you can have many others, assuming that you understand what kind of information they convey, and have your game become elevated by the usage of these kind of indicators. Again, if you know how to interpret them correctly, why not use them? Freely available, they're super easy to plot on your chart, to give you information. Why not add them to your chart? Okay, so we, in this kind of example, we used the RSI. You can find it on this kind of bottom side of the chart. And again, these are this is going to be an example of what not to expect when using the Fibonacci extension tool, because all the other technical indicators are not telling you that this is the end of the move and there's going to be a rebound from there onwards. And let's see what I mean by this. So again, what do we have here? We have Bollinger Bands. This is the upper bound, this is the lower bound, this is the midline, which is telling you pretty much how far of an extreme, how much of an extreme move is this. So we do look for breaks above or below the upper or lower bounds in order for us to get a glimpse of how oversold or overbought the market is, or how far the price action has went beyond itself, and therefore we expect it to come back towards the mean. The mean is the average line here. We have Bollinger Bands. We have two moving averages. The blue line a little bit much more thicker than the Bollinger Band line is the one, and the other one is the red one. Okay, so we have moving average where we can use moving average strategies, two moving averages, in order to gauge the current trajectory of the trend. And we also have RSI and the two Fibonacci, a retracement and an extension. Okay, so in this example, what do we see? We see, for example, let's just start with the RSI. Where is the RSI? RSI is between 50 and 30. That indicates that the bears are in control, not the bulls. So why extrapolate that the price action is going to head to higher ground? We don't have enough evidence to convince us that the price action is going to extend. Currently, the bears are in control. The logical scenario is for us to bet that the price action is going to do this rather than this. Okay, that's one point. Okay, moving averages, are they telling me the same thing? We're looking at moving averages. We have the short-term moving average, which is the red line, and the long-term moving average, which is the blue line. Currently, in the recent past, we have seen a crossover. Okay, so the red line, the short-term moving average crossing below the long-term moving average, that is a bearish signal. Okay, that means the bears are in control of this kind of intermediate or short-term kind of trend or shifting trend. Okay, so the bears are in control. So we have two indicators telling me exactly the same thing, that the bears are in control and the bulls are sitting on the sidelines. What else do we have? Bollinger Bands. We see price action being below the midline of the Bollinger Band, this thin blue line here. Price action is below the mean or the average or the mid-level of the Bollinger Bands, again indicating that the bears are in control, not the bulls, and we see the price action venturing and flirting closely with the lower band of the Bollinger Band, which is not a good news, because again, not a good news if you are expecting the price action to rebound. You don't have enough evidence. You have 3 out of 3 indicators telling you that the bears are in control. We have found some sort of temporary support there, which is the contrary to what the technical indicators are telling us. But at the end of the day, whom to believe, we don't know. Okay, if again the 61.8% level that the Fibonacci retracement tool tells us is important, we see fine, and we do see and find support here, and the price action ranging here, and the RSI crossing above the 50, and the Bollinger Band, and the price action crossing above the midline of the Bollinger Band and moving closer to the upper bound of the Bollinger Band, and the both two moving averages. We see the red line, the short-term moving average crossing above the blue line, the long-term moving average, in what we call a bullish crossover. Then we're going to have confidence that the price action is going to rebound. For the time being, our base case scenario tells us that the price action is going to do this. Okay, head to lower ground rather than upwards, until if and only if we see some sort of destabilization or a shift in trend, then we're going to do Fibonacci extension and possibly enter a position here and have a target somewhere in there. But for the time being, because we see the bears being in control, we're going to go short here if we get a break below this kind of level. If the price action does not hold above this level, if this is not acting as strong support, we're going to go short here. So we're going to sell somewhere in here, and we have Fibonacci extension tool below once again, assuming this is the start of the move and this is a pause. Maybe we're going to have a valid exit target being here. Okay, so we need to travel for the price action to travel from here, which is our entry point, down to, let's just say, the 161.8 important level, either to the upside or to the downside. Where is the pointer? Okay, here it is. Or if you don't have that much patience, use this as an exit level. Okay, so sell here, cover here, close your position, or buy something in order to close the sell position. Okay, so that's one way of visualizing Fibonacci extensions. Guys, if you have questions, please send them through. By the way, I forgot to mention, but yeah, that's how you use the Fibonacci extension tool with base case scenario, by using many other technical indicators to your in your arsenal, to make much more informed decisions. Okay, hopefully this example has been illuminating for you. Okay, what to expect in the next session? If I'm not mistaken, we're going to do ADX. I'm not quite sure, to be honest, probably next week. And from there onwards, we're going to do probably Ichimoku Cloud and a few live trading sessions. If you do find them interesting, we're going to do much more. If not, we're going to go back to the original schedule of this series. Okay, so I don't see any questions. I think we're going to keep this session. I'm going to close this session short, guys. Thanks for watching. Hopefully, we're going to catch you on next week for another webinar of our series. If you have enjoyed this, please go on YouTube and just leave with us a lovely review or a thumbs up or whatever that is, or a subscription. I don't know how it works. Please go ahead and do that. If you have any sort of question after this, please send them through. Send me an email. More than happy to answer any question you have. But because we don't see any sort of activity in the comment section or the Q&A, I'm gonna, let's just say, finish this session here. Again, thanks, guys. Hopefully you're gonna have a lovely weekend. Take care. See you next week. Ciao.